Welcome to Yahoo Finance Live. I'm Shauna Smith along with Pras Supermanian. Let's take a look at how markets are trading as we kick off the final trading week of the year. We know it has certainly been a down year here for equities, on track for the worst yearly performance that we have seen since 2008. You have the Dow, though, back in positive territory for the day, up just about 42 points. S&P, though, once again trading to the downside, off nearly 0.5% today. Taking a look at the Nasdaq 100, that's off nearly 1.5%. Taking a look at the bond market action, yields pushing to the upside, up just around 11 basis points at 386. That's for the 10-year yield. Taking a look at the 30-year yield, that's also up just about 12 basis points. Taking a look at crude initially jumping earlier today on the fact that China is reopening here, boosting demand. That's driving the price of crude up initially. We're looking at it, though, settling just below $80 a barrel. Digging into some of the individual movers. First, on a sector basis, we're seeing energy, the leader here, up just about 1%. Utilities not too far behind, lagging, though, consumer discretionary and also technology. For some of the laggards in today's action, we've got to point out what's going on with Tesla. Tesla off another 9% today, on track for its worst month, quarter, and year on record. Those year-to-date losses, we're looking at just about 68% to the downside since January 1st. Travel, a number of the travel names moving to the downside today. Thousands of flight cancellations over the last couple of days. That's putting pressure on a number of the airline stocks. Southwest, the biggest decliner there, off just about 6%. And I mentioned the fact China is scaling back its COVID restrictions, the reopening there, that's giving a boost to a lot of the China U.S. listed stocks. You're seeing Alibaba with gains of just about 4.5%. Baidu not too far behind. Pras up just about 4% on the day.
Yeah, let's get to up to speed on home prices here. The national S&P CoreLogic Case-Shiller Home Price Index fell for the fourth month in a row in October. Month-over-month, the index fell 0.5%, though it's still higher than a year ago. Miami, Tampa, Charlotte reporting the highest year-over-year gains among the 20 cities tracked. Higher mortgage rates have been weighing on housing. The 30-year rate in October was over 7%, though it has since retreated from that high.
All right, once again, most of the stocks moving lower here. S&P off just about 0.5%. The Nasdaq, though, the clear underperformer of today's market, off nearly 1.5% today. Let's take a look at some of these losses, what this signals for what we could expect in the new year. For that, we want to bring in Jay Hatfield, Infrastructure Capital Advisor, CEO and Portfolio Manager. Jay, it's great to see you. So I guess just your reaction to what we're seeing play out today, what we have seen play out so far this quarter, and what that signals is ahead in 2023.
Thanks, Shauna, for having me on again. What I think is really dominating the market right now is not a Santa Claus rally, but really a global bond sell-off, which started really with the ECB, but was exacerbated by the Bank of Japan. So we're hoping that rise in rates stalls out somewhere in the 4% level, and then that could set us up for, a better price action into the end of the year and the beginning of next week.
Hey, Jay, Pras, so you think that we hit that bond market low here? You think that's what's happening right now? We're bottoming out right now, and then possibly 2023, you can kind of see a little bit of a lift off there?
Yes, Pras, that's our thesis, is that you had mentioned, by the way, housing prices yesterday. That's really why we're very optimistic about inflation being below what the Fed is forecasting, because housing prices predict the change in shelter in CPI with a 6 to 12 month lag. And those have rolled over. We have our own index. It went negative, our own CPI real-time index. It went negative 3 months ago. So we think you need to have inflation coming down to get that bond market rally. And bond prices are not just important to fixed income, but also equities. And that's really why tech stocks are weak today, and really why stocks have done so terribly this year.
So, Jay, what does all this mean then, just in terms of Fed policy, how restrictive the Fed is likely going to be next year, and what this all means just in terms of the odds of a recession? Is there still a chance that the U.S. could avoid a recession?
We think so, Shauna. We're more optimistic than most, because we've studied the last 11 recessions, except for the pandemic. They're all caused by tight monetary policy, raising mortgage rates, and then crushing the housing market. Particularly in 07, 08, obviously, we were building 4.5 million homes a year. Now we're building about 1.4. The reason we're optimistic that we might have a technical recession, would be very mild. So we don't think we're going to get mass layoffs in these interest-sensitive sectors, really because of the pandemic and also post-financial crisis. So, but that's the sector to watch. But just last week, the new homes sold was 10% above expected. So it doesn't seem like the housing sector is crashing, but that's what we should watch, particularly in the first 6 months, because that's normally a weak time for economic growth anyway, as measured by the Commerce Department. So we think there's going to be a slowdown first 6 months, but then we could get a big rally towards the end of the year, even in the riskier tech stocks.
Hey, Jay, so looking ahead for 2023, based on what you just said right now and the Fed's sort of tightening cycle, what do you like next year? And is there even a play even in like real estate, for instance?
Well, we think so. We would still be defensive, particularly in the first 6 months. Preferred stocks is really our number one pick. Those are particularly of the ones that are $25 preferred, so they're traded on the stock exchange, so they're easy for individual investors to access. They're issued by public companies. And if you look at their 30-year default rates, they're about 0.3%, which is higher than investment-grade bonds, but high-yield bonds are 4%, so just 10%, less than 10% of high-yield bond default rates. So good credits, and that are very depressed. They're down about over 20% this year. So that's our number one pick. REITs, we think, if we're correct about inflation and rates coming down, REITs will also do well, particularly the pandemic recovery type REITs, retail REITs, even some high quality offices. So that's what we think, particularly for the 6 months, could work. And then if we do have a major rally, then the higher beta stocks could be appropriate in the second half.
Jay Heffel, thank you so much for that. We're just getting started here on Yahoo Finance Live. Coming up, the winter storm that has battered a large swath of the country has also wreaked havoc on Southwest Airlines. We'll tell you why they're still canceling flights. Tesla on pace to close lower for the 7th straight day, while Elon Musk's Twitter saga isn't the only thing dragging down shares. And Chinese stocks are jumping after the country takes a major step in reopening its borders. But an expert tells us why the recovery is far from over. Don't go anywhere. Travelers are anything but jolly after experiencing chaos at airports this holiday weekend. I was one of them. A winter storm causing thousands of flight cancellations, people stranded at airports, sleeping on the ground, bags piling up at baggage claims. Southwest taking the brunt of it, canceling over 8,000 flights between December 22nd and the 26th. So far today, the airline has canceled over 3,000 flights. That's all according to FlightAware. In fact, 70% of yesterday's cancellations were all due to Southwest. Delta and United fared much better, both around 10% of cancellations. Southwest releasing a statement Monday offering its heartfelt apologies. The airline said it was fully staffed and ready for the holiday weekend, but then the storm hit. President Biden tweeting about the cancellations today, writing, "Our administration is working to ensure airlines are held accountable." The president directing passengers affected to go to the Transportation Department's dashboard to see who was entitled to compensation. The Department of Transportation says it will investigate the cancellation from Southwest. For more on the travel chaos, we got to turn to Jim Cordar here, SimilarWeb's Senior Insights Manager and Travel Expert. So Jim, I had a big mouthful there. What's your take on what's going on here with Southwest?
Yeah, Pras, thanks for having me. First of all, it seems like after the summer of revenge travel continued into the holidays, winter weather plus a lack of airline resiliency conspired to play a trick on airline customers this holiday season, got their own form of revenge. Airlines are not suited to handle weather emergencies. After COVID, they cut staff, they cut planes, they have not fully staffed back up. So when something like this happens, they're ill-equipped to have the staffing necessary to respond to emergencies. Southwest in particular, with their point-to-point network instead of a hub and spoke system, when their planes get out of position, their staffs get out of position, they're ill-equipped to be able to respond. But in this case, they also did a horrible job communicating with the public. It seems they really dropped the ball here.
So Jim, they did a horrible job communicating, clearly did a horrible job planning for this. When we talk about how long some of these issues are going to persist, what's your best guess?
Yeah, I think it's going to be about another week before Southwest fully gets their act together. Their planes are still out of position, their staff is still out of position, and apparently they've had a significant technology outage in their staffing system where they outlay their staffs for the flights. So it's going to take a while. Customers are obviously outraged, more so at the fact that they've been left basically stranded at airports without any kind of information. Customer service agents are doing the best they can, but with a lack of communication from top, they don't know how to handle the situation.
Hey, Jim, why do you think discount airlines like Spirit and JetBlue didn't have these sort of same operational issues that Southwest suffered through?
Well, Southwest had the bad luck of being in the spots where the weather hit the hardest, places like Buffalo, the heartland of the country. So first of all, the weather hit them the hardest. But they did also have that technology outage, which left them unable to staff. So many flights didn't depart because there wasn't a flight attendant able to service that plane, or the pilots timed out because it just took too long to get their act together. Southwest seems to be uniquely affected because of their own internal issues. All airlines were affected by the weather, but Southwest, it's more than just the weather for them. It's how they handled it.
And Jim, you would think their reputation as a result is taking a huge hit because of this. How long does that overhang or backlash do you think is going to last?
Yeah, typically, I've been an airline analyst for 20 years. Typically, people have very short memories when it comes to things like this, but this may be a different situation. Just the extent of how long they've left people waiting with a lack of information may start to impact them. We'll have to take a look. Airline demand remains very strong. There aren't that many choices. If you're in certain markets, airlines tend to command 70 to 80% of market share in most hubs where they operate out of. So people don't have choices. If they want to travel, and our data is showing that they do want to travel, they have limited choices. So Southwest will probably see a rebound in the spring when travel starts to come back in general.
Yeah, Jim, so post-holidays, we're seeing, I know you're seeing that, the data is showing that people are really returning to travel, especially airlines and airfare. What are you guys seeing there in terms of demand pickup? And do you guys see it kind of going beyond what we had before the pandemic?
Yeah, our data shows we have excellent visibility into web traffic, and you have to go onto an airline's website to book before you travel. So that's a great proxy for demand. Our data is showing that we have fully recovered from the pandemic. December, year to date through December 23rd, December is up about 15% versus last year for the top 4 airlines. November was up about 7%, October up 15%. Fourth quarter looks great. That's going to carry over into the first quarter, into winter travel. And when we get around to next year, I know the inflation's biting, the economy is biting, but people are still showing a willingness to choose experiences over other types of outlays for their expenditures. So it looks like travel demand is going to be strong here.
So, Jim, you think that's still going to be the story in the new year? Because if you take a look at airfare prices, the latest CPI report showing the airfares are still up 30%, or more than 30% actually, on a year-over-year basis. I guess, to what point are customers going to just start scaling back and they're not willing to pay that high price anymore?
Yeah, I guess it all depends on how deep the recession goes and how long it lasts. I think what happened is because international travel was so slow to rebound because a lot of markets were closed, that revenge travel trend of the summer where everybody was finally going to Disney and other places moved to London, to Tokyo, to Australia. So that has a little bit more legs to go. But there will come a point where people are just looking to cut expenditures and will not travel anymore. But so far, our data is not showing that that's happening yet.
Hey, Jim, I was surprised to see that cruises and popularity of cruises is sort of nearing a high here. I'm surprised because I feel like after a pandemic, you don't want to go into a boat with a lot of people and have a virus kind of floating around there. So what's your take on that? Why are people back into cruising?
Yeah, when you look back to what happened during the pandemic, airlines were closed for a while, but they came back relatively quickly. Cruises were fully closed for an entire year. So there's a lot more pent-up demand for cruises. We also have the new Icon of the Seas ship that's created a lot of buzz. So people are thinking about cruising again, and there's a lot of pent-up demand for it because they couldn't do it for a full year. So that has a little bit more legs to go. We think this upcoming wave season, which is the time when people tend to book their cruises, which is January, February, March for the entire year, is going to be particularly strong in 2023. Cruise demand has longer legs even than the airline trend because, like I said, people had to wait so long to be able to go back to cruising.
Jim, what's your advice to people out there if they're looking to travel right now, the best time of year to book and where they should be searching for those deals?
Yeah, people are moving to OTAs rather than directly looking at the airlines at the hotels. They are looking for deals. There are a lot of web traffic sites that can help you with that. Hopper is one of them that's seen a lot of web traffic growth. These are sites that can help you find a good last minute deal. The longer you book out, the better you will do. Things do get to get tight, especially into still very tight capacity for airlines and staffing shortages. So airlines are not able to expand into this demand as much as they would like. So you should try to book early.
Hey, Jim, so what do you think about the other types of the OTAs you call them? Are they kind of like the trade you got to make here in travel?
Yeah, I think that if you are looking to benefit from the trading travel stocks, although I'm no longer an equity analyst, I can't recommend stocks. It does seem that people are looking for deals, so they're spending more time on these OTA websites, and that's a sign that Expedia, that Booking, those type of sites are going to do very well over the next 3 to 6 months, we think.
Consumers definitely becoming a lot more price sensitive. Jim Corridor, always great to have you of SimilarWeb. Thanks so much for joining us. Well, speaking of that storm that left thousands of travelers stranded, at least 50 people have died as a result of the winter storm that is sweeping across the U.S. That's according to various reports. Now, deaths have been reported in a number of states, including Colorado, Kansas, Kentucky, and Ohio. 28 of the reported deaths are in New York's Erie County. Now, Erie officials are pleading with residents to stay off the road, going as far as bringing in military police to help enforce a driving ban on the city of Buffalo, which has been buried in up to 50 inches of snow. All right, well, coming up, Tesla shares sliding once again today, off another 9% year to date. We're looking at losses of nearly 70%, the worst yearly performance that we have seen for Tesla. We'll have more on what's behind today's sell-off when we come back. After getting a bad rap over the last decade, hedge funds seeming to redeem themselves this year. Several in the industry reporting major gains so far this year. Yahoo Finance's Alexandra Semenova joins us now with more. And Alex, I guess some of these hedge funds really capitalizing on the changing market conditions that we have certainly seen throughout the year.
Exactly, Shauna. The hedge funds have been scrutinized over the past decade, and rightfully so, because performance has been lackluster and they charge some of the highest fees in the investment business. Just taking a look at last year's performance, hedge funds returned an annual 10.3% according to the Hedge Fund Research Weighted Composite Index. Meanwhile, the S&P 500 returned about 27%. And sure, different hedge funds employ different strategies, so it's not necessarily fair to compare them this way. But when you're looking at the industry broadly and seeing that unmanaged regular stock indexes are outperforming the industry when they're charging such high fees, that's really not a good look. But this year, however, did mark somewhat of a reputational turning point for the industry. Citadel was among this year's standouts. It's on pace for its most profitable year ever. As of November, its Wellington fund is reportedly up 32% year to date. Around that time, the S&P 500 was down 14%, now down even more. And at Citadel, performance was so good that Ken Griffin actually took his employees to Disney World. He paid for 10,000
sign of a good year.
His employees and their families for a three-day trip to Disney World. And then you have others like the D.E. Shaw Group, Millennium Management, all set for double-digit returns. And another point to make here is the Texas Teachers Retirement System actually performed much better than some of its pension fears because of its hedge fund allocation. So it was able to offset some of the losses in its stock and bond portfolios. Now, to be sure, it wasn't all good. There were a lot of hedge funds that did severely underperform. You have Tiger Global Management, which bet heavily on tech stocks, down more than 50% year to date. Melvin Capital completely shutting its doors. A lot of others that didn't do as well as Citadel and some of the good ones. But the point here is that this year's market drawdowns and the unexpected geopolitical risks that we've seen have really helped hedge funds reassert their place in investors' portfolios during a really challenging year.
So I know Coldplay played at that Citadel party. I heard about that. But what does this mean sort of for the industry going forward? People looking at how can I trade like a hedge fund? I mean, can you? I don't think you can. But where does the industry go now after such a banner year in 2022?
Yeah, so the struggle for hedge funds really started after the global financial crisis. We've seen a period of really easy money policies, stocks generally on an uptrend, and investors doing quite well. This really limited dispersion in the equity market, which is the range of possible outcomes for an individual investment. And now that we're seeing the Fed tighten conditions and we're not expecting the bull markets that we've gotten in the past, hedge funds may really play a role in investors' portfolios going forward. Warren Buffett in 2007 famously bet that over the 10-year period ahead, the S&P 500 could outperform hedge funds, and he was right. If he made that bet over the past 10 years, he'd still be right. But over the next 10 years, might not be the case. We're probably not going to get the type of bull markets that we've seen with higher rates ahead, concerns about growth, geopolitical tension still high. So hedge funds might be, shining bright coming ahead.
Well, I could hedge my checking account at some point. Anyway, Alexandra Semenova, thanks so much.
Thanks, guys.
Tesla shares sliding over 5% today, maybe at 7%, as the automaker heads towards its 7th straight day of losses for the first time since 2018. The latest issue here, Tesla reportedly extending its Christmas holiday shutdown in Shanghai by a day, telling workers there on Saturday to go home. Sources say Tesla is facing a wave of COVID infections that could be why we're seeing that shutdown here today. Also, Reuters reporting today that Tesla is shutting down in January for the Chinese New Year, leaving it only open for 17 days of production. Again, that's more than what they would normally be shutting down for, Shauna. So, I kind of got to say this is more about the drumbeat of demand, of demand falling is dripping. It's happening. It's every day you hear a news story about something going wrong in China for Tesla.
Yeah, certainly. I think a lot of the losses, at least recently, tied to the demand worry, what that looks like heading into the new year. We know we can expect higher rates, which has clearly been a headwind for Tesla. A number of these growth-oriented names, we're looking at losses over the last month alone of nearly 40%, the worst month that Tesla has seen on record. A number of analysts have been starting to sound the alarm just in terms of the concern that they have obviously the distraction of Twitter, what that means for Elon Musk, the CEO of Tesla. Dan Ives is out with a new note today saying that the reality is after a Cinderella story demand environment since 2018, Tesla is now facing serious macro and company-specific EV competitive headwinds heading into the new year. He does go on to say that Musk is viewed as, quote, asleep at the wheel from a leadership perspective for Tesla at the time. Investors need a CEO to navigate this Category 5 storm. So I think a lot of investors are scratching their heads a little bit, just wondering what that demand picture is going to look like over the coming months, how quickly Tesla will be able to kind of right the ship, because it has been a clearly challenging several months here for the company.
Yeah, and it's really this double whammy of demand is sort of at an issue here, right? Global markets sort of kind of coming down a bit, right? Rates tightening, but then also the negative sentiment for Elon Musk, right? So people don't necessarily want to be seen in a Tesla, supposedly is what people are saying. And you think about there's a huge amount of replacement of cars having to go from gas powered to EVs. That still needs to happen. And Tesla's really in the driver's seat for that. They are operating at a really remarkable level with their operations. The question is, can they take off the spotlight from Elon Musk, who is sort of commanding that every day? This past weekend, commenting on a Dmitry Medvedev tweet for the president of I believe, president of Russia, talking about how, these vast 2023 predictions is not really where he should be right now. He should be focusing more on the company, and that's what Dan Ives is talking about. Sleep the wheel. We don't need a Ted Stryker. We want an actual captain there. Yeah,
and Cowen was out with a recent note saying that there's a sense out there that the market share has peaked. Concerns about over-reliance on China. That's why we're seeing such a drop in the stock today, following the fact that they could be cutting back on production. But then on the more bullish side, you're right, they are such a leader in this space. EVs are the future. Tesla clearly has a wide margin there just in terms of the success that they have already seen within that sector. Canaccord was out with a more recent note saying that they're more positive just in terms of the innovation that is it continues to accelerate at the company, and that's in stark contrast to what we have seen as some of the other larger tech firms. And then they went on to say that, quote, green shoots of recovery may appear in the next year. So even though we have seen significant losses for the stock this year, a number of analysts, Dan Ives also being one of them, still has an outperform rating on that stock because they are confident that the company is going to be able to recover some of those losses in 2023.
Yeah.
We'll see.
And we'll get the Inflation Reduction Act effect for them starting January 1st. So anyway, coming up, Peloton unveiling its latest efforts at boosting sales. We have the details after the break.
Time for a triple play. 3 stocks that we're watching in the final 30 minutes of trading. We have AMC, NEO, and Peloton. Let's kick it off with AMC extending its losses from last week after the company proposed to convert preferred equity units into common shares. You're looking at losses of just about 7% today. Well, also we heard today CEO Adam Aron tweeting that he recommending the board freeze his pay for the next year, writing, quote, "I do not want more when our shareholders are hurting." He also went on to say that he has asked the company's most senior officers to forgo any increase to cash salaries in 2023 as well. Josh, we know Aaron loves to make headlines. He's always making it known just in terms of putting his thoughts out there. He wants everyone to know exactly what AMC is doing. I think the big question, though, is whether or not some of these efforts are going to help AMC shareholders in the long run and what exactly this business plan looks like into 2023 and beyond.
I think it helps interest in the AMC stock, right? And that's sort of what it seems like Adam Aron is trying to do very often in terms of what he's doing when he's tweeting out these statements. He wants people to know that he cares about the shareholders, and that's sort of why they invented this whole ape concept and memed it by naming it ape to begin with, right? They're trying to stir up meme interest there, and I think that's sort of what he's doing with the tweet here, Sean, is saying, hey guys, I'm thinking of you as shareholders. I'm really trying to think of you, so maybe help me out and maybe buy a couple more shares, Bros.
I think it's funny, I don't want more when our shareholders are hurting. Well, they're hurting pretty bad. Stock
very bad, yeah, off over 80% year to date.
Was it $45 stock? I mean, my God, I mean, this is just so brutal. And you know, you would think that with the return to theaters, reopening, the company gets something going, get some box office returns, Avatar out, but that seems to not really goose up the stock right now, at least for now. Maybe next year, we'll see, but maybe Adam Aron will take another pay cut next year, who knows. I'm watching NEO here. Shares dropping as a Chinese EV maker cut its Q4 delivery forecast to a high of 39,500 deliveries from a prior forecast of 48,000. NEO said it's facing challenges to production and supply chain due to the Omicron outbreak. This, of course, coming as China eases its COVID restrictions. Again, you know, we're seeing that good part, the positive part of China, showing, you know, we're going to open up the borders, we're going to ease restrictions, get our companies back full force, but then it's got a high unvaccinated population, so people are getting sick. And you're going to see that, I guess, going through until, I guess, early next year.
Yeah, exactly. And I think the big question here is just in terms of the reopening process, how long will it take for the economy to recover? So many Chinese have been hurt just in terms of the underperformance that we have seen this year because, and really over the last couple of years, because of the hard stance that Xi Jinping has taken with the zero COVID policy. So we are seeing those restrictions being scaled back now. Of course, the fact that they will be opening their borders next year, no longer imposing that quarantine, which you think would mean obviously good news here for their economy, but a number of analysts, a number covering the space over there, just saying that that recovery could take much longer than maybe we had initially anticipated.
And another thing, too, that I think is interesting with this, guys, is to see NEO cutting their guidance as well as what we've seen from Tesla, right? We've heard a lot of Tesla investors that have come on this era say, well, it's not necessarily a Tesla problem. China's not a Tesla problem. Wait and see what happens to the other EV makers. And you're sort of starting to see that from all the names. So not a lot of good news for Tesla these days, and really not good news here either, but perhaps maybe it's slightly positive spin there for Tesla. Now, my play today is Peloton. Shares sinking roughly off about 6% today as they launch the new Peloton Certified Refurbish program. Now, this program offers a $300 discount for refurbished bikes and Peloton bikes and a $500 discount on the Peloton Bike Plus. So those bikes now both still retail for over $1,000. And with the refurbished Peloton bike now fetching just shy of $2,000. And those price points are what really stick out to me still here, guys. When you talk about a company, investors are looking for a really positive story here, a new way to fix that revenue graph that you can see there on your screen that has been declining quarter over quarter for several quarters now. You need something new and different. I don't know if a refurbished bike that now is still increasingly expensive, it's still very expensive. I don't think that that's what's going to bring new customers into Peloton Pros.
I can get a cheaper bike on eBay right now.
Right.
You know, why would I want to get this unless they give me a warranty? They got to get the subscription revenue going. They got to get the bikes out and get people to pay $40 a month every month, and that'll, like, I think, make the company more compelling buy. You know?
Yeah, I think the price break that you said we would just get with $300 to $500. I don't think that really moves the needle just in terms of getting a significant number of new users into Peloton. I don't know, maybe we are wrong, but certainly Peloton has a massive issue because as the economy reopened, more people returned to the gym. They canceled their membership. We saw that membership number actually decrease in its most recent quarter. When you take a look at the stock performance today alone, you're seeing that this announcement from Peloton isn't really doing much to excite the street. And guys, Remember, this is a company that had a market valuation of nearly $50 billion in early 2021. Now at today's price, we're looking at a market cap of just over $3 billion. So you talk about that dramatic of a drop. We know the new CEO, Barry McCarthy, has laid out a massive turnaround plan. But I think the big question is just the number of steps that will be needed and are necessary in order to get Peloton, if it ever can, recapture some of the success that we did see early stages of the pandemic.
We feel like they just need something else to change the story here to a post-pandemic story, right? A major gym partnership, getting into gyms in some way, getting people involved in a different way that way, rather than we're still selling that same product, that same bike. Investors don't want to hear that story anymore, clearly.
And it's also been rumored that could potentially be a takeover target. So we will see what happens with Peloton in the new year. All right, well, coming up next, if you're in the market for a new car, there may be some good news in the next couple of months. We'll talk to an expert about what the auto market expects to see next year. Stay with us. New projections from Edmunds forecasting that new car sales will total 14.8 million next year. That's up 7% from its latest projection for the current year, 2022. So here to discuss that and also the most important trends to watch in the new year, we want to bring in Ivan Drury. He is Edmunds Director of Insights. Ivan, it's great to see you. So certainly 2022 was a challenging year for the industry. We had higher rates. We also had the fact some supply chain issues affecting companies here. Also, the fact that the consumers were facing higher prices. Is 2023 going to shape up to be maybe a stronger year for the industry?
Stronger in the sense of sales, definitely. I mean, we will see an increase. We'll see that bump up to like 14.8. But at the same time, are they going to be as healthy as the sales that we've seen last year? Definitely not. In the sense that the automakers and dealers, they're not going to be getting those premiums that we've been seeing all of last year. It was almost like a 18 or 16 month streak where we had seen that, ATPs, average transaction prices, were over MSRP. Only in November have we finally seen consumers paying a little bit under. So the sales will be good, but will it be as good and as profitable for the dealers and OEMs? Not nearly as much.
Hey, Ivan, Pross here. So you're saying that you'll see this recovery in 2023, but we'll also have higher rates. Is that not going to dent some of these sales?
Certainly that's the case. And that's the reason why our expectations for sales isn't even higher, is that there are some consumers, they dropped out in the last year because they didn't like the price. This time, consumers are going to drop out because they don't like the price of money. That interest rate is taking a huge dent into consumers' budgets. If you look at the average transaction price of, they're like close to $50,000 now, the amount financed is $40K, APR is 6.6%. You're looking at interest over the life of the loan for a new car close to $8,000. Used cars, you have similar metrics, but the amount financed is lower. It's $10,000 interest over life alone. So we're seeing that those numbers are now cost prohibitive. If you can't get like an OEM backed lower APR, like a 0%, a 1.9, something like that, you're looking at hefty finance charges over the life of a loan.
Yeah, car loans certainly getting more expensive. Ivan, though, I guess a piece of good news, sliver of good news, is the fact that new vehicle prices are expected to drop, although people are still going to be paying a pretty penny for a number of new vehicles. How big of a drop? Can you quantitate, I guess, just put that into numbers term for us, just in terms of how big of a drop we could potentially see?
Yeah. For most of the year, we'd seen the consumers were paying an average of $700 over MSRP.
Mm-hmm.
November, we saw a little haircut. It was like 17 below. We're not talking about prices from years ago when consumers were easily saving $2,000, $3,000 off of MSRP. You had incentives that were widely available, things like that. So we expect that during the next year, prices will get better. Don't expect to go to the dealership and find the exact same situation you did 5-6 years ago. Back then, we were selling something like 17 million units a year. There were plentiful used cars for sale. Selection was great all around. Had a lot of off-lease cars. That's really not the case for next year. We're still going to have consumers who are finding that the vehicles that they want just simply aren't available on the dealer's lots. So there's still going to be people ordering cars, but there's going to be people who order cars, but when it comes down to the F&I component, they can't afford that car. And the car might just basically fall off the truck, essentially, and it might be up for grabs for someone else. But when we look at next year, definitely expect to see prices softening, but don't expect some blowout sales.
Yeah, I mean, what are the kind of trends you guys seeing for EVs next year? I did a story about how we're going to see some cheaper EVs come to the lots, but still supply might be a little limited. Is that what you guys are kind of seeing too?
Yeah, so many EVs. All of last year and the year prior, we'd seen hand raisers that said that, I want to buy this car sight unseen, no test drive. Launches were happening online. Consumers were saying, I want to buy these without ever seeing them. People were cooped up in their house and they're buying these cars. The same thing is happening. We still see that many vehicles are essentially sold out from some of the mainstream automakers like F-150, the Lightning. You're looking at something that's sold out for nearly 2 years. General Motors, they're launching their near $30,000 vehicle. That's going to have so many reservations that unless you act now, you're not just going to go to a dealership and find exactly what you want for sale, especially in the EV market. They're still very expensive compared to their ICE counterparts. And the thing is that many of them, they do have reservation lists that are either full or they're closed.
And I mean, when it comes to leasing versus buying, I think that's a big decision that a lot of people are up against right now, trying to figure out what makes the most sense. Certainly, leasing has gotten more and more expensive. Do you expect that to continue? And will there be any deals for the buyer out there in 2023?
Things might soften up a little bit when it comes to leasing, but we've just seen such a big hit. Leasing used to be 1 out of every 3 sales in the industry. Now it's something like 17% of sales. Consumers who are accustomed to leasing where you just show up, get that new car, get a great incentive where the price is lower than MSRP, the money factor is very low, the money's almost free sometimes. Things like that, they just don't exist anymore. We're seeing that people are paying to borrow almost at the same rate as if they're financing the car. So if we do see inventories build up a bit, we might see a little bit of a return to leasing. But right now, it's very questionable. You have to really decide, is leasing for you based more upon the merits of leasing itself versus just the price point alone?
Ivan Drury Edmonds, thanks so much for joining us.
Yeah, no problem. Thank you.
Coming up, 2022 was a big year for Gary Gensler and the SEC. We'll recap what the agency did and did not do this year coming up. From crypto to the environment, the SEC has been in the spotlight this year in a way it hasn't been in the past. Yahoo Finance's Jennifer Schomburger has the details.
From bringing the biggest lawsuit on fraud in crypto history to new rules for the stock market and climate regulations, the Securities and Exchange Commission will be remembered in 2022 for proposing landmark rules, but also for actions it did not take. The SEC proposed the biggest changes to rules for the U.S. stock market since the mid-2000s, prompted by the GameStop meme stock frenzy in 2021 that saw online brokerages and market makers struggle to handle huge volumes of stock trading. The new rules would change the relationships between brokerages that take investors' orders to buy or sell securities, high-speed traders that handle the orders, and stock exchanges. The aim? Create competition for investors' orders to lower prices while increasing oversight of market makers.
It's about driving greater competition, transparency, and efficiency in the marketplace. And we have a marketplace today that, depending upon the day, between a third and a half is not in what's called the lit markets, but is in the dark venues, dark pools, or just being purchased by wholesalers. So it's trying to consider recommendations to better level the playing field between these venues.
Meanwhile, more than a decade after Congress passed the Dodd-Frank Wall Street Reform Law, the SEC approved a rule to claw back executive compensation of companies that have had to materially correct financial statements. And in a first of its kind, the SEC proposed requirements for publicly traded companies to report information on greenhouse gas emissions and risks related to climate change. But a decision by the Supreme Court to curb Environmental Protection Agency's power to regulate greenhouse gas emissions has thrown into question whether the SEC could impose climate rules. Finally, 2022 was a year that saw major enforcement action from the SEC against crypto firms. But it was also void of new rules tailored to crypto, causing members of Congress, the crypto industry, and others to blame the SEC for the meltdown of crypto exchange FTX. The SEC has filed a lawsuit against FTX founder Sam Bankman-Fried for defrauding equity investors to conceal using customer funds to support his hedge fund, Alameda Research. When asked during a recent interview whether it was finally time to write rules tailored to regulate crypto, SEC Chair Gensler wouldn't say. Instead, he said existing securities laws are in effect and that the agency will enforce them. This year, the SEC levied a $100 million charge against BlockFi for failing to register its retail crypto lending product, a record fine against a crypto firm. The agency also fined Kim Kardashian for touting a crypto security on social media without disclosing she was paid to market it. Gensler's goal for 2023? Making crypto exchanges and lending platforms come into compliance.
They can do that appropriately, working with the SEC, or we can continue on the course with more enforcement actions, and I would have to say that the runway is getting shorter.
And this year, the SEC also finalized a rule that would impose tougher restrictions on how and when corporate insiders can buy and sell stock. Back to you guys.
And Jennifer, certainly has been a very busy year for the SEC. Let's look out into 2023 just in terms of what Wall Street should be focusing on. What is that?
Hey there, Shauna. So I detailed a lot of rules that the SEC proposed this over the past year, but these rules still need to be finalized before they're actually implemented. So we talked about the U.S. rules for the rules for the U.S. stock market. That's a big rule that the SEC is probably going to focus on implementing next year. Another one, payment for order flow, which would require basically broker dealers to execute customers' trades at the lowest possible price. Also on the agenda, looking at finalizing those climate regulations, though those have been called into question since the Supreme Court reined in the EPA's ability to lower greenhouse gas emissions, causing questions about whether that could apply to other agencies like the SEC, though Gary Gensler has implied there's a lot of interest in that. They're still taking public comment, and he seems to want to move forward with that. So those are some of the major issues on the docket for next year that Wall Street is watching.
Certainly a lot to keep track of. Right, Jen Schomburger, great job. Thanks so much for that recap. Let's take a look at where things stand here with just about 7 minutes to go until the closing bell. Dow still holding on to gains, barely up just about 32 points. S&P and Nasdaq, though, in the red. We'll have more on that when we come back. Just a couple of minutes here from the closing bell. Jared Blickery has a close look at some of the big movers of the day. Jared, what do you got for us?
This is an action-packed day here. So let's start with the travel sector. Got to start with Southwest Airlines. Stock is down 6%. I'm going to put a year-to-date chart on. Can scroll through some of the news. Massive flight cancellation delays are rocking the airline stocks. And wow, Southwest having its worst day in weeks, if not months. The punitive storm of a century, the snowstorm of a century at least, led the air carrier to cancel 2/3 of its flights today alone. Southwest issued another statement less than an hour ago advising customers it's working closely to urgently address the situation, the disruption, saying it's not a staffing problem. Instead, it is a problem with overwhelmed scheduling tools, and also stating that they're going to be operating on a reduced schedule for several days. So just taking a look at the industry here, we see most of these stocks underwater with the exception of 2 Chinese stocks, which is a good transition because in a day of risk off, you're going to see a lot of green and dark green here. This is one of the few bright spots for risk today. Chinese authorities rolling back even more COVID restrictions, no more quarantine for international travelers, though a PCR test still standard procedure 48 hours before boarding. Chinese internet ETF KWeb having its best day in nearly 3 weeks, while notably U.S. tech stocks taking another drubbing. And let's take a look. All of these are green except for a few. And if you'll notice a pattern here, Li Auto, NIO, XPeng, all those are EV stocks, all those down. We're going to get to China in a second here, but we want to move on to the mega cap sector and take a look at this. We were just talking about Tesla. Well, Apple down 1%, Amazon down 2%. And let's take a look at Earth's most important stock here. only today reaching lows that are actually 52-week lows. So in part and parcel with this being a risk-off day, we're seeing this expressed in some of the mega caps here. Although some of the newer entrants to the mega cap space, where we're seeing United Health, Visa, ExxonMobil, those stocks are up. So kind of a continuation of this bifurcated market that we're in here. Want to end on gold and silver here while we got a little bit of time here. This is another bright spot. We're seeing some of the miners like Freeport-McMoRan, that's up 2%, and also gold GLD, that's up 2% as well.
It's certainly some outperformance there from gold, at least today. But Jared, what about Tesla? Because going back to some of the underperformers, not only of the day, but when you take a look at the losses that we've seen in Tesla for the month, for the quarter, for the year, certainly underperformance that we have never seen ever.
Yes, I've just been watching this just kind of unfold today. Only a few minutes ago, I was saying worst day for Tesla since April, could be even worse right now. This is a really risk-off environment, and it's really unusual to see this happen at the end of the year. We're supposed to be seeing a Santa Claus rally. Instead, we're seeing the fringes of the market and some of these mega caps take it on the chin. Let me just show you what's happening in meme stock land as well. We're seeing Coinbase down 8%, AMC down, GameStop down. These are not trivial moves here. So when we see not only some of the core, but the edges of market going down, I think that's par for the course for this year. All right, I'm going to end on, well, I would like to say an up note, but I guess we can make it at whatever note we want. We're going to see energy, that's up over 1%. Consumer discretionary is the worst performing sector. And here's your closing bell, the first of 4 in this holiday shortened week.
That's the closing bell today on Tuesday, the 27th. Taking a look at the markets here. The Dow eking out some green here, up 37 points, barely a 0.1% higher. The S&P down 0.4%, and the Nasdaq down 1.4% around there. Jared noting those mega caps taking a big hit there, along with Tesla weighing down heavily on the Nasdaq. So let's get more on this market, on the broader markets, and also the Fed's bringing in Federated Hermes head of International Equity Group, Martin Schultz, and Sound Planning Group CEO David Strzelecki. Guys, thanks for joining us. Martin, I'll start with you. What's your take on today's sort of market action? We're in a period of low volume here as the year comes to an end.
Yeah, I think 2022 was a tough and interesting year. I think the fact that we don't have the Santa Claus rally, as was just mentioned, is an indication that, and if you think about everything that's happened in the last year, crypto, situation. You've got first land war in Europe in over 75 years, and everything else post-pandemic. So I think growth was in favor for the last several years, and I think with the global economy slowing, we're going to continue to see the markets digest the economic scenario as it revolves around central bank tightening. And I think central bank tightening will continue to upend the markets to a degree that is unexpected. And so near term, we think that the weakness may continue, but possibly later, second half 2023, we're going to see a better market conditions.
David, what do you think? Do you agree just in terms of how we'll likely start the year and what we will likely see from the Fed in terms of policy over the next several months?
I do. As far as the market goes in the Santa Claus rally, we're below the 200-day moving average, not very bullish. Additionally, we're about to be facing, earnings season coming up here in the next few weeks, and ultimately find out, how analysts' expectations actually, rounded out. And so I don't feel very positive as we're heading into 2023. I agree that, with Federal Reserve Chairman Powell, that we're going to be higher for longer, as it seems that inflation is a little bit sticky as we're reshoring different parts of our economy, as there's supply chain challenges still kind of being spotty out there. And, ultimately borrowing costs have doubled over this year. So that really affects consumers. That really affects corporate earnings, and especially junk bonds. So, I'm very concerned right now, but I have an optimistic, personality. But here's reality. What goes up ultimately comes down, and we're seeing cycles change today.
Hey, Martin, what do you think about that inflation? Is it as sticky as you think people are saying? Is it going to affect sort of housing markets like we're seeing today with markets coming down a bit there in housing prices?
Yeah, inflation will probably stay higher for longer than people expect. And, we've just finally, this last 6 months, had our team really scoped the world and finally getting on the ground. The one place we haven't gone to is China, obviously, which just is now finally opening up. But inflation is something of a global phenomena. And on top of that, I think central banks, not all of them, but many of them, are in a situation where they will continue to hike into this higher inflationary situation. Again, we have a situation, for example, in Japan, where we will potentially see wage increases for the first time in over 30 years to the degree that they're expected this spring. And it's really the labor market that's the tight scenario that will potentially keep central banks on edge and continue, if you will, this push towards decreasing the inflationary situation.
David, in terms of what has already been priced into the market when it comes to an aggressive Fed and what we could expect to see in 2023, we're looking at the S&P off just over 19% so far this year, the Nasdaq off over 33% since January 1st. Has an aggressive Fed, has that already fully been priced into the market?
I don't believe it's been fully priced into the market because, we're still debating whether there's going to be a recession or not. Bloomberg came out and said 65% chance based on everyone that they've surveyed to say that there's going to be a recession in 2023. Interesting, though, Visa said 83% chance, Fannie Mae 85% chance. So I think if you get the consumer right, Visa, Fannie Mae have pretty good data on that. I think that you understand where we're going here as it relates to the future. So I think that, when we look at stock prices, we look at PE ratios. Price got affected by inflation, and the challenges that we're facing right now, supply and demand. This next year, I think that there's going to be an earnings recession, very likely anyhow, as we're going forward here. So I don't think this has been priced in. I don't think the average consumer has actually even been really prepared because we're not talking about budgeting. We're not talking about the things that they can be doing to protect themselves right now, given what the Federal Reserve has declared that they have to do, which is 2 million more unemployed need to happen. They're going to be raising rates until they start seeing inflation come down. That sounds great. I think we're seeing it right now, but I think that things are going to get a little bit sticky here as we get around that 4% inflation rate, as their goal is to get down to 2%. And so again, people need to be very aware of how they're allocating today. And so being more protected, very important. But also our strategies and how we invest need to be adjusting to this new normal that we're recognizing today. So we're no longer in a growth economy, but it's turned to more fundamentals. And my encouragement is that people evaluate their strategies and portfolios because there's never been a better time to get things right. And so focusing on things at the end of the year as we go into 2023, critically important, I think, to our success.
Yeah, David, talking about that earnings recession, a number of analysts out there predicting that we could see an earnings recession in 2023. I guess the question is, how deep of a recession, how bad could it potentially get? What's your view?
I think that there's a lot of crosswinds today. And so it's challenging. I mean, I've kind of got a best case scenario and a worst case scenario. So if the Fed can do the splashless landing, then, it doesn't have to be a deep recession. It could be, shallow. We could turn things around. Maybe they can accommodate and drop rates in a significant way. Maybe we get a 40-year mortgage. I don't know what they're ultimately going to do, but it seems like there's so many different things. If I can use the analogy of Jamie Dimon saying that, that there's a hurricane coming. Here's the point. We can prepare because we recognize the changes in our atmosphere as things begin to spin and go crazy. There's just so many different cross currents right now with a global recession occurring. It seems like this is probably going to be on the deeper side or the longer side than on the shallow and short.
Hey, Martin, last question to you, my man. So you're looking at growth across the globe, not just in the U.S. Where are some of these sectors you're looking at that are going to be pretty attractive for investors right now?
Well, I think first geographically, we're looking at Asia, and then a lot of the commodity-oriented markets in the Middle East, potentially South Africa, Brazil, and that sort of thing. And then when you look at actual sectors, I think to David's point, we are seeing an earnings hit and basically margin hit across the world as the companies try to hold on to labor longer than would ordinarily be the case, in particular here in the U.S. But from a sector perspective, we do like healthcare, we like energy, and really it's all about really defensive, good growth companies that have the ability to kind of manage through this potential recessionary cycle. And so, at the end of the day, the dollar, I think, we saw it go parabolic earlier this year, 2022. It's down more than 10%, more than 12% versus the yen, for example, more than 10% in a weighted trade weight adjusted perspective. But at the end of the day, the dollar, I think, is providing some better liquidity. The lower dollar is providing better liquidity situation for the rest of the global economy. And so as the U.S. slows, we're finally going to see China come back. And, you were talking about some of the the FANGs in the U.S., the Teslas, the Apples, and the like getting hit. Well, that already happened in China within the last year and a half. And so we're probably actually going to see some of these big tech Chinese companies at least outperform relative to their U.S. and European counterparts.
All right, certainly setting up to be a challenging year here for investors. Martin Schultz, David Shizeski, thanks so much for joining us here this afternoon. Well, speaking of China, China's starting to reopen its borders next month. Of course, that's what's driving the action in the market today. But don't expect its economy to start recovering right away. Find out why when we come back. China is ending its zero COVID policy after 3 years of lockdowns, with plans to reopen its borders and scrap quarantine rules for international travelers. Now, here to discuss what this means for China's economic recovery, we want to bring in Shahzad Kazi. He's China Beige Book's International Managing Director. Shahzad, great to see you again. So let's talk about what this means for China's economy, how quickly the economy there is expected to recover. What do you think?
Yeah, hi, good to be with you. I think first things first, the question is no longer about the speed with which China reopens. The real question now is how quickly can Beijing undertake the policies that are necessary for it to gain control of the virus, which primarily means being able to vaccinate the vast majority, at least of its population, starting with folks in the urban areas, and create the conditions which allow people to actually participate in the reopening, because that is ultimately what is going to drive this recovery. We have to keep in mind that right now we haven't hit the peak of COVID cases. That is still ahead of us, which means that some of the bad news is still ahead of us. And till we are past that point, we can't really start talking about an economic recovery. Right now, we're just talking about getting this engine started. We're nowhere near being off to the races right now.
Hey, Shahzad, so how optimistic are you that China can actually get to that point where they're actually immunizing a lot of their citizens to the point that they have kind of a herd immunity?
Yeah, look, I think the first 2 quarters of next year are going to be critical. Because that's where, we're talking about a very large population. That is, if there's a serious effort made towards inoculations and boosters and so forth, that is going to take a lot of time. The next 6 months, or rather, I should say the first 2 quarters of next year, are also going to be critical because they're going to help us understand just how long the Chinese economy needs to fully rebound. I'm optimistic that we're going to start seeing some positive signs of recovery on the consumption side and so forth. But we are in a pretty deep hole right now, especially when you look at the property market. It is struggling. By all accounts, the Chinese economy is very, very weak. This is not an overnight recovery story.
And Shahzad, speaking of the deep hole and what is currently playing out right now in China, we've certainly gotten from China's leadership, at least recently over the last couple of weeks, a clearer pro-growth tone from them. Is it too little too late when it comes to investors or attracting the international investors that were once very interested in China?
Look, I think the markets are incredibly bullish in China once again. And as a matter of fact, they are bullish before the data have shown any signs of turning. Now, what we want to wait and understand is what exactly is the nature of this pro-growth policy? Because we often hear these statements coming out of Beijing, but the actions are not aligned. Right. So how much monetary stimulus do we get? How much fiscal stimulus do we get? I think we're starting to see certain amounts of support within the property sector for sure, for the developers who are now taking over these bad projects, who are now going to be helping rescue the homes and stuff that had to be delivered to households. So you're seeing some amounts of support from them in the credit sector, or rather through credit provision. We have to see how much bigger this gets. One thing, though, I do want to point out, let's say you get a pro-growth, set of policies next year, you get a good amount of stimulus in the economy next year, you see a resuscitation of the economy. The overall environment is not a good one. If you're seeing a slowdown in the US and abroad elsewhere, that's not very good for Chinese growth again.
Mm-hmm.
Given the sort of unknowns we have going on right now, do you think you'll see some multinational companies sort of pull out their supply chains and go somewhere else in Asia or even Africa or South America?
Yeah, I think supply chain diversification is certainly something that is and should be top of mind for corporate decision makers. I think, the interruption to day-to-day operations that we're getting right now in China, what we saw happen with the quote-unquote iPhone city and with Apple, I think just goes on to show that lack of clarity on the policy-making front in China does at times make doing business a little bit harder. So I think some of that supply chain diversification is going to be happening. On the other hand, of course, you have a Congress, you have Washington, D.C., which is actively and aggressively, I think, in certain ways, thinking about supply chain diversification as far as critical industries are concerned. So certain industries will have no option, I assume, in the coming years, but to really seriously think about this.
And Shahzad, when it comes to kind of going back to what you were saying before, just the fact that we will likely see cases rise pretty substantially, talking about some of the fallout that we could get as China does reopen its borders. When putting that collateral damage in perspective, what more specifically do you think that reopening is going to look like? And then when it comes to the economy, is there a risk then that the economic conditions there will deteriorate even further before we start to see some improvement?
Yeah, I think that's exactly it. I think what the data are going to continue showing is that the economy is going to slow down. Additionally, we're looking at things getting worse, exactly as you said, before we start to see a recovery. I think Chinese businesses will need to see some amounts of macroeconomic stability before they feel confident to hire again, to invest again. Chinese households need to see and make sure that there is stability on the policy-making front, as well as improvement on the COVID situation before they feel comfortable to start digging back into their savings and to go out there and spend again. So I think we're looking at a slower recovery than perhaps has been anticipated by investors so far.
Shahzad Kazi, thank you so much for joining us.
Thanks.
Ahead, winter storms have not only challenged major commercial airlines, the CEO of Wheels Up tells us how it's affecting private jets as well. That's next.
In today's Best of Yahoo Finance, we take a look back at our conversation this fall with IBM Vice Chairman Gary Cohn, where he shares his thoughts on Fed policy and what needs to happen in the labor market heading into the new year. Let's take a listen.
We all know that this monetary policy takes time to feed itself through the economy. Unfortunately, it hits consumers almost immediately. So if you've got an adjustable rate mortgage, it adjusts the next day. If you've got credit card debt that adjusts, it adjusts the next day. But the real policy effects on slowing down demand, that takes months and almost a year to a year and a half to feed through the economy. So there's this discussion going on. Has the Fed done enough in interest rates to slow down the economy? And we don't know because the effects are still being felt of the first rate increases, or have they not done enough because we continue to see inflation move higher and higher? So I think the Fed is in a very difficult position. They were late to the game. They started raising rates late, which means they're now playing catch up. I think we all believe that they will raise rates 2 more times this year at the 2 more meetings, probably at least 75 basis points in the November meeting, and probably another 50 to 75 basis points at the end of the year. So we will have gone from basically, 0 Fed fund rates in the United States to well over 4% rates in the course of a year. That's a fairly dramatic move, and we need to understand what impacts that's going to have longer term to the economy.
And what impacts do you think it could potentially have longer term? And are we going to be able to do this without going into a recession?
Well, the question is, what are the impacts? And as I said, the Fed can try and affect demand, the demand side of the equation. They can make borrowing money more expensive. They can make homes more expensive. They can try and slow consumers down because things are harder to buy because they don't want to finance them. They can't affect the supply side of the equation. And right now, when you look at the data and you look at what's going on in the inflationary front, a lot of the inflation comes from commodities and commodity inputs. So by raising interest rates, we don't create more oil. We don't create more food. So we're trying to create a balance of oil. We're trying to create a balance of food. We're trying to create a balance of workers back into the labor force. I think one of the big underlying components of inflation is wage price inflation. We keep seeing 5+% wage inflation. Wages filter through everything we do. As the economy has shifted during COVID to where we're buying lots of goods because we really couldn't leave our houses, so we were buying things, we were having them sent to our houses, and we were consuming goods. We're now back into a more normalized economic cycle. And in a normalized economic cycle, we as Americans, we're good consumers of services. We like to go out, we like to be entertained, we like to travel, we like to go to events. The service economy is all labor. When you go out to a service event, you're really buying mostly labor. So when you go to a concert or you go to a restaurant or you go to a bar, you're buying some inputs, some commodities, but you're buying an awful lot of labor. That labor cost has not come down. And it's another area where the Fed is trying to get some response. They're trying to get businesses to not grow as fast. They're trying to get people businesses to not hire as many people. But we saw, even in last month's unemployment report, we saw 3.5% unemployment. We still see non-farm payrolls growing. So the interest rate impact has not fed through to the business cycle yet. We're gonna have to see job destruction if we're really gonna see inflation be curtailed. And I think that's hard because we've gone through a lot of fundamental changes in this country. Prior to COVID, we were all talking about the aging American workforce. Guess what? We're still an aging American workforce. We didn't stop aging during COVID. Unfortunately, during COVID, we lost about 2 million people from the labor force, either through long COVID or unfortunately they passed away, which is a horrible event, but we've got to recognize we've lost people from the labor force. And then we had a bunch of people sort of late in their work cycle who decided to leave the labor force. So we now have a smaller labor force population in the United States. So businesses, to attract workers into the labor force, are having to pay more to get workers into the cycle, which is inflationary. Wages go up. They pass those increased wages on to the consumers, and we're in this inflationary cycle. So the Fed's going to continue to keep raising rates to try and break this cycle. They won't know they have broken it till long after it's broken.
So what does this mean then for the equity markets? Because here we stand today, the S&P off more than 20% year to date, Nasdaq down more than 30% year to date. When you try to gauge that downside risk here for equities, what does that look like?
So again, the famous adage, don't fight the Fed.
Yeah.
You know, it's been true for this cycle. It was true for last cycle when we had a zero interest rate policy. You wanted to own risky assets. When you've got the Fed increasing interest rates and the alternative, the risk-free rate, the rate of return at now sort of 4% for short duration treasury bills, that's an attractive rate of return for short-term treasury bills. And really what's happening more than anything is the equity market is trying to figure out what are the future earnings of a company. So remember, the value of a stock is the present value of future earnings. So if a company has higher input costs and it has higher labor costs, and hopefully if the Fed is successful, lower demand for their goods or services, what does the forward earnings of a company look like? Then I could put a multiple on that. And right now, the market is trying to determine what forward earnings are going to look like and what multiple that should trade at. And as long as the Fed is continuously raising rates, trying to slow down the economy, trying to make things more expensive, trying to make labor more expensive, the market is going to continue to try and find a clearing price for that. It's like everything else in this world. We won't know we've met that clearing price till long after the bottom is here. We may have met it already. A lot of people think we have not got to that clearing price, but the market right now is trying to figure out what future earnings look like and what multiple we should put on that.
Gary, I'm curious to get your perspective on this. The job that Fed Chair Jay Powell has done so far, are you satisfied with that?
I think they were late to the game. You know, I don't like to criticize the Fed. I don't think any of us like to criticize the Fed, but they've got a tough job. But they've got an enormous amount of resources at their disposal. You know, they stuck to this transitory inflationary argument way past where I think many of us, myself included, I'll make this personal, way past where I thought it was transitory. Maybe in the beginning, as we were bringing production back online, we're bringing supply chains back to a normalized level, there was some transitory natures to it, but the Fed stuck to their transitory argument way deeper into the cycle, and it was clearly not transitory. We clearly had real inflation in the system. We had shortages, we had food shortages, we had energy shortage, we had a tough time getting people back into the labor market. So as I said, the Fed was late, and when you're late, you're playing catch up, and I think they continue to play catch up.
And that was Gary Cohn joining Yahoo Finance earlier this year. But Pras, even though that conversation was a couple of months ago, it still holds true today because the Fed is still fighting high inflation. Yes, we have seen some improvement, but 7.1% year over year increase is still substantially high, much higher than what the Fed would like to see. And now they're kind of caught in this very tough spot. And you just heard it from Gary Cohn saying that, yes, they were late in the game, but they have a very, very tough job at this point. They're doing the best that they can in order to fight inflation, in order to break the cycle, but they won't know they have broken it until long after it has been broken. So I think the question here is the impact that is going to have on the economy, whether or not the U.S. is going to be headed for a recession or Fed Chair Powell will be able to, and he has remained pretty positive on this and confident that the Fed will be able to walk this fine line, but able to do this without sending the economy into a recession. We'll see.
Yeah, you know, I like what Gary had to say about the labor market and how that pain that we might have to create for them is necessary in order to tame down inflation. And he's right about the fact that we lost a lot of workers, both due to just leaving the workforce, but also, you know, Jay Powell mentioned 600,000 people died during the pandemic, and that really affected the amount of labor available, and that also raised the prices of wages. So I think there is a kind of multiple aspect here besides the fact that we had, you know, component shortages and things like that. It's the fact that we don't have enough workers, and we're struggling to get more workers, pay them enough, but then, don't pay them too high enough to keep inflation going.
Yeah, certainly a very, very tough spot. And we're seeing that also play out from employers because employers simply aren't able to hire, many employers, I should say, aren't able to hire the number of workers that they need. Supply and demand when it comes to the labor market is still significantly out of balance. How long that's going to take to correct, I think, is the big question here. And how we resolve that is also a huge issue. And what it's going to take to get so many workers that are still sidelined, that have been sidelined since the start of the pandemic or during the pandemic, what it's going to take in order to get them back into the labor market. So certainly a crucial couple of months here to watch in terms of the economy and what all plays out and how long it's going to take in order to maybe for the Fed to get inflation all the way down to 2%, although some are saying the Fed should actually settle to 3%, maybe even 4% before, and then start easing back just a bit.
Or at least pause a bit, right?
Yes.
You know, and then Gary talking about that. When is that market? When is the market? When is that bid moment, right? When are you going to buy the market? So we'll see that happening. Hopefully soon. We'll see. Yes. Coming up, the CEO of Wheels Up tells us where his company is flying passengers this holiday season. Stay with us.
Southwest and many other major airlines were forced to cancel thousands of flights over the holiday weekend as winter storms and staffing shortages left travelers stranded nationwide. So here to discuss that, what demand looks like for private air travel heading into the new year, we want to bring in Kenny Dichter, Wheels Up Chairman and CEO, also our very own Ali Garfinkel joining the conversation as well. Kenny, it's great to see you again. Certainly a very tough couple of days for your industry. Southwest alone canceling nearly 2/3 of its flights today and tomorrow as it tries to climb out and kind of get a better hold on everything that has transpired over the last several days. My question to you is, how much have you been impacted and what have you done at Wheels Up to kind of counter some of the massive cancellations that we have seen play out across the country?
Well, first off, our operations teams deserve a big applause. They've done a great job on behalf of our members. Surely we're not immune to the weather, and our folks, our members, for the most part, have gotten exactly where they need to get to on time and, sort of within an hour or two of departure. We're subject to some of the commercial action in that we move our crews and some of our maintenance folks around on the system. But I would say that our team did an incredible job planning. And I would say we're taking a tremendous amount of inbound volume to see what kind of availability we can squeeze in for members that were booked commercially that need the private service. So again, really thankful that our team was prepared and did a great job.
Kenny, Ali here. You mentioned there's a lot of inbound volume, which I'm sure is what you want to see, but I'd also love to hear about how you're managing that kind of volume given the pilot shortage and how you're thinking about that, dealing with that shortage for the foreseeable future.
Yeah, well, like I said, we're in a very unique position. We got a great pilot force. We have a partnership with Delta Airlines. We just recently put together a program called Delta Propel that helps us collectively recruit pilots for a career in aviation. You can start in Wheels Up, you can graduate to Delta, and of course, the mandatory retirement age for commercial is 65. We can fly our pilots Part 135 out till their early 70s in many cases. So a great partnership, and that keeps our pilot force alive, well, and kicking. That said we always welcome demand. Over these peak period times, we take care of our members and folks that have made commitments to us first. Any slack in the system, we're obviously open to new customers and prospects, but 98% of our focus is on our members and getting them to where they need to get to.
So Kenny, part of it is the pilot pipeline, which from the sounds of it, sounds like you guys are in a pretty good position. What about the training aspect of this? But because we know that's critical in order to set your company up for future success.
Yeah, I mean, look, supply chain and training and all of this stuff that's happened during COVID, again, we're not immune to it. We have our pilots in training right now, up to speed. But again, it's such a great place to be and to work, and we believe in our folks. 100%, 24/7. And again, like I said, I think for a career, it's a great place for a pilot. Again, private aviation right now is there's a premium to it. Again, you're able to get from A to B, control your schedule. And during these holiday times where, again, we're in the experience, where seeing one's loved ones are tantamount and most important, we really feel like we're in a great, unique position.
Kenny, Wheels Up stock is down 76% year to date from what I've gathered. I'd love to hear a little bit about what a successful 2023 means for you and what you're expecting to see out of next year.
Well, Wall Street's looking for path to profitability. We're right now on a program where we've made a commitment to Wall Street for a period of time between now and 24. We're going to get there. And during 24, we pledge EBITDA profitability at some point in that year. We're trying to accelerate that. Our top line has been incredible. We put up 39% year-over-year growth in our last quarterly earnings, our third quarter. And again, during the crisis, top line was what Wall Street was looking for. We're shifting directions here and going to tamp down a little bit on that growth. And we're going after profitability. We have a plan in place, and I think we'll be rewarded in a very strong way once we get there. We need to execute.
So Kenny, a two-part question here. One, you said that you're tamping down on some of that growth. Are you cutting in areas? And if so, where? And then the second part of it, you mentioned the strong year-over-year growth that you guys just posted in your last quarter. I know revenue was up more than 30% on a year-over-year basis. What does that demand look like more specifically this holiday season? And what are you seeing as you look out into the new year?
Well, we're still a growth story. We're looking for responsible growth here, and we want to grow as a company. The demand should supply and demand line up. We could be a much bigger company from a top line perspective. But again, I think most important, we have to demonstrate the idea that we can have responsible growth along with profitability. So at the end of the day, we want to deliver a premium service to great members and great customers. We want to digitize, organize, automate our space and make it easier for customers to access private aviation, while at the same time a profitable growth story.
All right, well, we will continue to cover your company and see how that all shapes up in the new year. Kenny Dichter, Wheels Up CEO, thanks as always for hopping on a Yahoo Finance here. And Ali Garfinkel, thanks to you as well.
Thanks. Happy holidays.
You too.
The breaking news here, the Supreme Court is keeping in place a Trump-era immigration restriction known as Title 42. The policy was instituted during the start of the COVID pandemic. It allowed border agents to immediately turn away asylum seekers to the border. The 5-4 decision reverses lower court rulings that Title 42 had to end in December. The court agreed to hear oral arguments in the case in February.
All right, well, coming up, from shortage to glut, chip makers are facing a new problem: too much inventory. We'll tell you how it happened and how long it's here to stay when we come back.
After a pandemic shortage that drove up the prices of everything from cars to dishwashers, chip makers around the globe are contending with the glut of supply. Here to break it down is Future Research Principal Analyst Daniel Newman. Daniel, so we saw Micron claiming its inventories are now well above target levels. What exactly happened here with this chip glut?
Well, just like we ended up in a shortage, nobody really expected so much demand to come on so quickly, and chip makers weren't able to ramp up the inventory quickly enough. And so as that demand kind of swelled and stayed intact for more than a year following the initial pandemic, as people bought cars, gaming consoles, PCs, servers in the data center, same thing happened on the way down. You know, we saw what happened with the Fed. We raised rates. We see we're heading into a recession. Discretionary income is down. People's balance sheets at home are not as good as they were. And all of a sudden, all these companies that ramped up have all this extra inventory, and effectively, we don't have the demand we had. And so now the inventory is there and prices are coming down and chip makers are hurting.
And Dana, we certainly have seen a number of chip makers respond and start to shift their operations or how they're approaching business over the coming quarters. Micron cutting 10% of its workforce as that demand drops. When it comes to these inventory levels, the fact that they are so swelled at this point, how long until those inventory levels, I guess, get to more appropriate or what is, I guess, considered a historic norm?
Yeah, we're hearing different things from different leaders in these companies. We've heard from NVIDIA's leadership that it should be sometime at the end of this quarter, which for them ends in January. We heard Sanjay Mehrotra of Micron say probably in the second half of this year. I think some of the specificity is going to go around whether are they data center chips, are they automotive chips, are they gaming consoles, are they PCs? Each of these have their own sort of boom and bust cycles, but of course we're seeing sort of an overall bust cycle right now. I like the chip companies that are more centric to things like cloud, data center, and automotive. And those that are really heavily into gaming and PC, I think a lot of their demand got pulled forward, and you could see it a longer time. So that's why Mehrotra said second half of this year, NVIDIA's gaming chips, parts of Intel and AMD, they're probably looking at second half or later before they really start to see normal demand come back.
Hey, Daniel, so I covered the auto sector, and we're still seeing a lot of the chip crunch happening there across a number of automakers. You mentioned that it's specific to different sectors. What is it about these chips that the auto sector needs is not, the industry is not actually pumping out enough of them?
Yeah, it's really interesting. The automotive sector depends a lot on these lagging edge semiconductors, which is, 14 nanometer and above. These are often produced by, the likes of Tower Semiconductors, Global Foundries. A lot of what we're hearing, the resiliency, the fabs being built are more of these newer leading edge. These are the 5 and 7 nanometer process. So what's happened is we have all this demand peaking for automotive. You've got cars now that have more semiconductors in them than ever before. And we haven't really increased the production capabilities like we're doing, and we haven't finished yet, but on a lot of these leading edge with the CHIPS Act. So we don't have the production capabilities to kind of get up to all this demand we had for automotive. And so we're still seeing car prices are still pretty high. Used car demand is still a little bit swelled. And all these chip makers are going to need to keep ramping up production to ever catch up on these automotive designs that are semiconductor intensive.
We heard from Intel CEO Pat Gelsinger back in October, and he said, quote, "It's just hard to see any points of good news on the horizon." We know that Intel then issued a muted outlook. They also announced job cuts. Is there any reason to be optimistic about this sector heading into the new year?
Yeah, if you zoom out overall, it's really hard to see a world that isn't going to be accelerated by technology, whether that's supercomputing and AI, whether that's the next generation of vehicles, data centers in the cloud, and the software that enterprises run to operate. All these things require semiconductors. Over the next 12 months, during a tighter recessionary period, I believe companies are going to try to do more with what they have technology-wise, which means less buying of PCs and servers, which means, a tougher outlook in the short term. But in the long run, the amount of software, the digitalization of everything means more semiconductors. You really got to follow those boom and bust cycles. We are in a bust cycle that was accelerated by a crazy boom, but the semiconductor tends to run pretty closely with those economic up and downs. I think as we start to come out of this economic downturn, you'll see the semiconductor volume pick up in a big way, as it's going to be critical to the advancement of our infrastructure and of business.
Hey, Daniel, so do you think that the CHIPS Act will kind of help that boom bust smooth it out a bit more? And who can really actually benefit in terms of the companies from that act?
Yeah, that's a great question. I mean, some of this demand planning, the supply chain issues that we have, the hyperdependency we've created with Taiwan, I mean, we definitely put ourselves in a bit of a difficult situation. We, of course, have great relations with Taiwan, but there's a lot of microaggression going on with China that's creating some discomfort. We've got, some new tariffs and some new regulatory and policy going against certain chips shipping over to China. We need to bring more production here to the United States. We need to bring more production on the leading edge. We need to bring more, as I mentioned, with automotive on some of those lagging older, process technologies, 14 nanometer and above. I think Intel's got the biggest opportunity to benefit, but we're seeing Micron, IBM. I mean, TSMC is reaching out for money, and all the fabless companies can benefit from some of the dollars that are there for innovation, R&D, and design in the extension of the Chips and Sciences Act. But I like Intel's prospects. If they can get policymakers behind them, this could be a good moment for Intel. But of course, TSMC has had so much success. It'll be interesting to see, does our government back the Taiwanese manufacturer to do more leading edge here, or does more dollars go to Intel, which may be a good idea for the national security and resiliency that we are needing in the future?
Certainly a number of stories to keep an eye on when it comes to the chip sector in 2023. Daniel Newman, as always, thanks so much for joining us here this afternoon. Well, Netflix releasing the sequel to its Knives Out franchise last Friday. Glass Onion, which had a limited theatrical run over the holiday weekend, scored an estimated $13 million at the domestic box office. So how did the movie perform on Netflix over the long holiday? Yahoo Finance's Ali Canal joins us now with the numbers. And Ali, it looks like it was a big hit.
It was a big hit, 82.1 million hours streamed in the first 3 days on the Netflix platform since that December 23rd debut. But still, that is not enough to put this movie in the top 5 Netflix film debuts of all time. It actually secures it in 6th place behind Sandra Bullock's The Unforgivable, Ryan Gosling's The Gray Man. The number 1 film debut is still Red Notice with nearly 149 million viewing hours in the first 3 days. But you mentioned that limited theatrical release over the Thanksgiving week, only about 600 theaters. It was not available in every state or every city, but industry insiders still estimated that the film brought in $13 million domestically. And we even heard from Netflix CEO Reed Hastings, who said that they left a lot of money on the table by not extending this theatrical release. So considering the debut was so-so, I think they might revisit that strategy in 2023. All that being said, you know, this film could still add viewership throughout December into 2023. I know I'm going home tonight to watch this. I know a lot of people on our team have already binged this. We have a 93% critic and audience score on Rotten Tomatoes. So I think word of mouth will help add to this. But again, that debate between streamers' relationship with the box office, that's a big story that I'm going to be watching in 2023.
I always thought that, Netflix doing this box office strategy kind of added a bit more oomph to the streaming side of things in terms of like getting kind of notoriety for the movies that are on the platform. Speaking of movies in theaters, is Avatar week 2. What's going on there with that?
Well, with Avatar, it was better than opening weekend. We saw opening weekend for Avatar miss expectations there, but the film secured an additional $95.5 million domestically as that global total nears the coveted $1 billion mark. Box office analysts are very encouraged by these numbers, especially since we had very severe winter storms throughout the United States that likely impacted theatrical attendance overall. Now, all that being said, The Way of Water likely will not be the #1 movie of 2022. That is going to go to Top Gun Maverick, which has secured $1.4 billion globally. Also, Jurassic World Dominion, that had a $1 billion haul worldwide. So we'll see if this Avatar sequel can eclipse that number. But box office watchers are really focused on that slow burn through the holiday week into 2023. There's not that much competition. The next big blockbuster is the 3rd iteration of the Ant-Man franchise, which is expected on February 17th. But also on premium formats, the Avatar sequel has performed very well. IMAX shares closing the day up 3.3% today after the company announced that the sequel had earned $105.5 million in IMAX global box office in less than 2 weeks. And that's the fastest film to hit that $100 million milestone for IMAX since April 2019. So it seems like what people have been saying, what analysts have been saying, that you have to play the long game with the Avatar sequel, that could be true, but we'll see what 2023 brings.
We talked about James Cameron and that long burn, that slow burn. He's been known for that, so we'll see with Avatar.
He's over that, and this film is already outpacing the original.
Have you seen it?
I don't think I'm going to see this one, guys.
You got it. Entertainment reporter. I think we might have a pass.
3 hours and 12 minutes, though, and I just was not a huge fan of the OG.
Yeah.
I got to admit it. I saw it on a date in high school, and maybe it's the
maybe
date
that's why. Yeah, exactly.
Because it was not a good date.
Yeah.
Maybe you need to give it a second.
So maybe I need to give it a second.
And if you go to the theater, this would be the movie to go to the theater for.
I heard the visual effects are amazing, so.
Well,
just for that.
3 hours out.
I'll let you know if I see it. How about that? Ali Canal, thank you so much. My stock to watch for tomorrow is Cal-Maine Foods. The egg company is scheduled to release its fiscal Q2 results after the bell tomorrow. Analysts are expecting earnings of $4.24 a share on revenue of $798 million. We'll be looking to see what the company says about pricing going forward. A deadly avian flu outbreak combined with higher feed and energy costs have caused egg prices to skyrocket. Prices are up nearly 50% from last year, according to the BLS. And coming up, one musician is taking a stand on its frustration with Ticketmaster in an unusual way through his album title. We'll tell you who it is next.
Ticketmaster can add another name to its list of musicians with a score to settle. Rising country star Zach Bryan releasing a surprise album over the weekend titled All My Homies Hate Ticketmaster. Now, Bryan announced a collection of live tracks on social media on Christmas Eve, writing in quote, "Seems there is a massive issue with fair ticket prices to live shows lately, and that he's doing all he can to, quote, make prices as cheap as possible and to prove to people tickets don't have to cost $450 each to see a good and honest show." And Pross, this is just the latest musician. We know Bruce Springsteen has criticized Live Nation in the past. Taylor Swift, obviously, one of the bigger names that has fallen in the crosshairs of all this, taken issue with the pricing practices of Live Nation. Policymakers now also jumping in and asking a lot of questions.
Well, and also naming your title after how much all your homies hate Ticketmaster is a pretty interesting way to critique the company. You know, I think no one likes them, right? Bands don't like them. Fans don't like them. Maybe even venues don't like them. I'm not even sure. So it's a business model ripe for destruction or disruption. The question is, how will that happen? I have to, I mean, look, didn't Tidal try to do this too? Like, wasn't there other types of operations trying to do it? Musician-backed companies trying to do this, and for whatever reason, it can't get done. I just don't know why.
Yeah, I think right now Ticketmaster, at least a position that Live Nation is in, certainly lacks competition in that area, so they have the ability to charge these prices. Of course, that's the issue that policymakers are pressing right now. Senator Amy Klobuchar being one of those policymakers kind of leading the charge. She sent a letter to the CEO of Live Nation asking a lot of questions, demanding answers, and of course asking it on behalf of so many fans that have been disappointed over the last several months. All right, well, that'll do it for us today on Yahoo Finance Live. Thanks so much for joining us this afternoon. It's been fun.
Thank you. I
gotta come back and visit soon. I will be back tomorrow at 3 p.m. Eastern Time for all your coverage leading up to and after the closing bell. We'll see you then.